Hello number-curious friends, welcome to the channel where we talk accounting and finance. Today we are going to talk about something extremely important in financial analysis, debt-like items. Because here is the reality, a company can look financially healthy, but still hide significant obligations outside traditional borrowings. You, therefore, should ask one key question. What obligations behave like debt, even if they are not called debt? What can hide behind the classical balance sheet classification? So, what exactly are debt-like items? Debt-like items are typically obligations that may not sit inside loans and borrowings line on the balance sheet, but economically behave very similarly to debt. Such obligations will have the following main characteristics. Future cash outflow will happen. They are often contractual. They are usually unavoidable. They reduce financial flexibility, and, often, related expenses are not part of underlying EBITDA, which is used for valuation of the businesses. These items are extremely important when calculating adjusted net debt, leverage ratios, equity value and purchase prices for businesses, and credit risks. So, what are the most common debt-like items? These include lease liabilities, pensions, unpaid M&A related costs, dilapidation provisions, dividends, income taxes, restructuring liabilities, factoring liabilities, break fees, minority interest, and so on. This topic is important and often controversial, so let me know if you want any other items to be discussed in detail. I will make a separate video on those. One of the most common debt-like items today is lease liabilities. Under modern accounting rules, leases are recorded directly on the balance sheet as an asset and a corresponding liability which reflects the committed lease payments in the future. Examples of leased assets include warehouses, office buildings, aircraft, trucks, production equipment. Even though companies may not call this bank debt, they still must make future lease payments, which are currently not reflected in EBITDA. Yes, when leases are recorded on the balance sheet, they are expensed as depreciation and interest below EBITDA, as EBITDA is earnings before depreciation and interest. Economically, this behaves very similarly to borrowing money. Especially relevant this accounting approach became after so-called sale and leaseback transactions became popular. What was happening there? For example, an owner of the warehouse decided to improve cash position of the company. To do this, the company sold a warehouse to someone and leased it back. What happened as a result? There was significant increase in cash on the balance sheet at cost of some additional expenses in the P&L which are yet to come, and this could have been close to non-existent. For example, if the transaction happened on the 30th of December and you're looking at the 31st December balance sheet and full year income statement. In this case, there will be expenses for one day only. That's why, very often, lease liabilities are included inside adjusted net debt to reflect increased financial commitments of the company. We will do a separate video on leases. The next popular debt-like item would be unpaid M&A costs and earn-outs. First, when companies acquire businesses, they incur a lot of transaction-related costs, which may not yet be settled. These are debt-like, they do not relate to normal operating activity. In addition, the buyers often do not pay the full purchase price immediately. As an example, initial payment happened today and additional payment will take place later if certain targets are achieved. These targets may be future revenues or profits. This is called earn-out. For example, a company buys another business for 100 million today, plus up to 20 million later if profits grow with defined growth rates. Even though the future payment depends on performance, it still represents a potential future obligation. Earn-outs can be fixed or variable, and variable earn-outs can be linked to EBITDA or revenue or to stock price. And they may be based on complicated formulas and definitions and include multiple components. Another debt-like item, declared but not yet paid dividends. Imagine you have 10 million of cash on your balance sheet. This cash is partially generated from the prior period profits. The owner of the business now decided to distribute 5 million in dividends. That means that effectively available cash on the balance sheet decreases by 5 million, because the dividends distribute earlier profits, which are included in the 10 million. Debt-like. In the end of the day, we have only 5 million in cash. Next debt-like item is loan break fees. Sometimes, companies refinance debt before maturity. In such cases, banks may charge break fees, prepayment penalties, or refinancing costs. For example, if a company wants to repay all debt early because interest rates declined, the lender may require compensation for lost profits. Or the new purchaser of the company may not need debt at all and wants to settle it completely to save on interest costs. In general, almost all loan agreements will contain so-called change of control clauses, where banks have right to terminate the agreements during M&A transactions and charge the company for break fees. Why are these debt-like? These obligations arise directly from financing arrangements and can consume substantial cash. The next interesting item is factoring and supplier finance. Have a look at our previous video for details on factoring. The link is in the upper right corner. Factoring creates one of the most misunderstood debt-like items, and it does create a lot of arguments. Again, we will have a dedicated video on factoring as a debt-like item versus part of net working capital. During simple factoring arrangements, the company sells receivables to a bank. Here the key question is, who takes the risk? And there are two common outcomes. If the bank fully assumes the risk, this factoring is called without recourse. It's a true sale of receivables. If the company carries the risk and the bank can return uncollected receivables, this factoring is called with recourse. Here it behaves more like financing. In substance, receivables may simply become hidden debt. In this light, supplier financing programs can also behave like debt. Instead of paying suppliers directly, banks step in and finance payments. So, economically, this may look much more like borrowing than trade payables. Another major debt-like item is pension deficits. Here, we normally speak about so-called defined benefit pension liabilities, where companies are fully committed to make future retirement payments and do not transfer them to external pension funds. Normally, the companies still invest in some assets to cover the exposure. But if the pension assets are insufficient, a deficit exists. For example, pension obligations are 1,000, pension assets are 800, deficit is then 200. The company will eventually need to fund this shortfall with cash. In addition, the liability on the balance sheet covers multiple years from old times, not necessarily reflecting the current results of the company. That's why pension deficits are often treated similarly to debt. Some provisions can also behave like debt. Examples may include environmental cleanup, so-called dilapidation provisions, litigation settlements, long-term or extraordinary product warranty liabilities, restructuring costs. But important to know, not all provisions are debt-like. Here, you should usually focus on long-term, unavoidable, cash-settled obligations. Now, another controversial debt-like item, deferred revenue. Check out our previous video for details on it, the link is in the corner. So, deferred revenue means customers prepaid the company. As an example, annual software subscription paid up front. You can say it's not debt as no repayment is needed. But at the same time, you can say it still creates obligations to deliver services. Yes, you will not repay it, but you will pay for external hosting, salaries, etc. You will ultimately still incur cash outs to deliver the service for the next year. So, dependent on the situation, deferred revenue may or may not be considered debt-like. Why debt-like items matter? Debt-like items can dramatically change leverage analysis. For example, traditional net financial debt is 100 million. Then we add lease liabilities of 25 million, pension deficit of 10 million, earnouts of 30 million. Our adjusted net debt is now 165 million, and that's a huge difference. And it may completely change valuation, covenants calculations, credit ratings, or acquisition pricing. Adjusted net debt profile is normally different for different industries. Retail companies would have large lease liabilities as they rent a lot of shops. Industrial companies may have significant pension deficits. Technology companies may have earnouts from acquisitions or virtual option programs following the recent years of rapid growth. Consumer goods companies may have supplier financing programs. Airlines would have material aircraft leases. This is why serious analysis always goes beyond the face of the balance sheet. Real financial risk is often hidden in the notes to the financial statements. Debt-like items remind us of a very important principle. Accounting labels do not always reflect economic reality. To understand real leverage, you must look beyond the word debt. And that's the snapshot of some debt-like items. In the next video, we will look into the cash-like items. If you have other questions, post them in the comments below. Thank you for watching. If you enjoyed this video, hit like, subscribe and ring the bell so that you don't miss the next video. See you soon and keep those debits equal to your credits.